Okay, I think we'll get started because I'm not sure how many people are still going to join. Maybe they're a bit late. Welcome to those that are joining us today. Thank you very much for your time. Allan Gray and myself decided that we would try and host something that's a little bit different and obviously taking into account the current times that we are in. So we put together about 5 webinars stroke Zoom sessions that we're going to launch to my client list, obviously, and the people that are interested will join, and hopefully we'll be able to send them out as a recording after today, just so that if you missed it or if you want to refer back to something that was said, that you'll have the presentation. Any questions, you're welcome to put it in the chat at the bottom. We might not get to it today, but we will email the responses through to you. So thanks for your time. If you don't mind, I think everybody has already, but if you could just switch off your video and mute your mics, and then I will hand over to my esteemed colleague who works for Allan Gray. He's going to take you through the presentation because I think most of you are tired of listening to my voice. So the first topic that we'll be discussing today is pre-retirement products. In other words, what can you use to save up for retirement? Just back to basics in terms of what's available. And then we'll touch a little bit on post-retirement in terms of what you can draw down, what is the recommended amount. And then our next session will focus on all the different types of products, both pre and post-retirement. We'll go into a little bit more detail. So yeah, without further ado, thank you for your time again, and I'm going to pass over to Shauib.
Thanks so much, Marcelle. So my name is Shauib Mollagee, and I'm a business development manager with Allan Gray. I've been part of it for Allan Gray for about 5 years. And as Marcelle discussed, we're going to touch on back to basics for retirement. And just to jump straight into the agenda, there's 4 particular items that I wanted to touch on, and it's how do I know if I'm on track? So the first thing is how thinking about my existing retirement savings, and how do I know if what I've saved thus far is essentially sufficient for the capital that I'm going to have at retirement. And then also mistakes that I should avoid, or particularly 5 investment principles that you need to be following throughout your retirement journey. And also the products, like what vehicles can I use to essentially achieve that capital amount at the end of retirement. And then one important question that we're always getting is how much income can I withdraw? How do I know that when I'm drawing an income, how do I know that it's going to be sustainable during the time that I actually need to be earning an income? But before I jump into the actual content, one thing that I wanted to clear up is the concept of time and investing. So a lot of people start investing at the age of 25, and they invest for about a period of 40 years. So that makes you 65 at the time that you're about to retire. And then people generally they look to earn an income for about 20 to 30 years after retirement. The problem with this is that sometimes you're young and you start investing, and sometimes you don't start at the age of 25. I'd hope at that point in time that there are people that's working and considering starting to save. But the reality is that we don't often have 40 years to save for retirement. And then also, a lot of people think that if they retire at 65, they're not going to live long after that. So they don't plan for long at retirement. And you could find yourself sitting in a situation where you actually live for maybe 30 years or 40 years, and you live till 100. And you need to worry about sustaining yourself during retirement. The mathematics of essentially saving a small percentage of your income during this 40-year period to sustain your 100% of your income after retirement would essentially only make sense if you follow specific investment principles. So how do I know if I'm on track? Like I said, you kind of want to get an idea of whether your existing savings is going to be sufficient to sustain you during your retirement phase. And some really smart people came up with a number of 17 times your final salary that you earn when you decide to retire. So if you decide to retire at 65%, 17% of that final amount that you're earning as a salary would cover about 75% of your income at retirement. So if we look at an example of how that would, if we look at an example of that, if I am age 65 and I'm currently earning, or my last salary is 360,000 Rand a year, or 30,000 Rand per annum, essentially in order for you to cover 75% of that amount, you require a lump sum of 17 times by the 360,000, which is about 6.1 million. So it seems like a lot, and it is a lot, but there's two important things to take into consideration with this calculation. The one is the 17 times, which is your capital amount, and the other is the 75% of your salary. In order for these numbers to essentially make sense, for the 75% of your salary to make sense, it takes into consideration the fact that you're not paying off like a mortgage during retirement. It takes into consideration the fact that you don't have dependents, anyone that's reliant on your salary during that time. And it also assumes that during that period, you're going to make some sort of adjustment to your lifestyle. Obviously, when you retire, you aren't able to maintain the exact lifestyle that you were while you were still earning an income. Right? So those are the important things regarding the 75%. With the 17 times, that only makes sense if, first of all, you're earning a real return, which is essentially a return above inflation. And that would also only make sense if, like I said, you adjust your lifestyle. But essentially, the 17 times would only last a particular amount. You have to be able to adjust your lifestyle to account for that capital and for that capital to essentially last you for retirement. And how do I know if I'm on track? So if I start at a particular time, so what this table looks at is whether you start at a particular point in time, what capital amount do you have to have after saving for a certain amount of years. So if you look at the table, you can see that if you've been working for 20 years, essentially you're supposed to have about 5 times your annual salary. The problem is obviously you don't know what your final salary is going to be, but the table gives you a guideline on where you should be. So if you look at, for example, 30 years, if you've been working for 30 years and essentially saving for 30 years, you should have about 10 times your annual salary. So if I look at the table and I realize, okay, cool, I'm really not on track. What do I do from here? There's another table that we actually use where it assumes that you're going to be achieving CPI plus 5% return annually during your retirement savings. If you start at age 30, right? If you decide that you're 30 years old now, you want to start saving for retirement. This assumes with achieving the 5% return, you essentially need to be investing about 22% of your gross annual income. The same thing can be said, for example, if you start saving at age 40, and this assumes that you're obviously going to be retiring at age 65. If you decide to start saving at age 40, with a 5% annual return, CPI plus 5% annual return, you essentially need to be saving about 41% of your gross income every year. So I know that these tables look a little bit daunting, but essentially this is reality. If you don't start saving as soon as possible, or essentially start saving a significant portion of your salary when you start working, you're going to be forced to do so at retirement where you're not working, you're not earning an income, and you'll be forced to essentially adjust your lifestyle at that point in time, which is obviously not what we aim to do. And then just to touch on the mistakes that you should avoid, were essentially the 5 investment principles that you need to follow to ensure that you have that sufficient capital saved up. The first thing that you need to do is essentially start with a plan. And there's important questions that you need to ask yourself. For example, where do I want to be? How long do I have to get there? And what do I need to do to get there? And that kind of leads you to start thinking of like short-term, medium-term, and long-term goals. And examples of this, for example, a short-term goal would be an emergency fund. If you may be in a car accident and you urgently need funds to cover that. If, for example, medium-term could be whether you're planning for marriage, you're looking to buy a home, or you want to save for your child's education. And then a longer-term goal would obviously would take into consideration your retirement savings and also the legacy that you essentially want to leave behind for your children or for your partner. And the importance of drawing up these goals is so that when the time comes that you actually need to, for example, buy that car or you want to get married, that you're not touching your retirement savings during that period. The importance is that you're going to have all of these things, all of these funds set up so that when these goals do occur, you have funding to back that up rather than taking from your retirement savings. The worst thing that you can essentially do is for you to withdraw a portion of your retirement savings when, for example, there was a downturn in the market and your investment return isn't doing that well. If you withdraw from that portion, you're essentially going to be stunting the growth or prolonging the recovery of that capital that you just withdrew. So principle number one, start with a plan, drop your goals. The second principle is start as soon as you can, right? So this graph shows two investors, right? Then the second line will pop up in a second, but it shows two investors, and the first investor, well, both of them invest an amount of 20,000 or essentially 15% of their income, right? The only difference between investor one and investor two is that investor one starts 10 years before investor two. And as you can see, the growth in the capital in the first 10 years is not that significant, right? So if we add investor two to that, you can see that in the next 20 years, when investor two decides to start investing, you can see that the capital growth starts increasing exponentially. And then in the last 10 years of retirement, you can see the major difference between the two. Investor one has almost double the amount that investor two has, which is a significant amount. It's about a capital difference of about 44%. So some of you might look at the graph and say, I can actually afford to maybe not save for the first 10 years. But if you don't start investing as soon as you can, it's not actually the first 10 years that count, it's the last 10 years that count because of the effect of compounding. You can see how the effect of compounding here and the effect that it had on investor one because he started 10 years earlier. So like I said, it's not the first 10 years that you lose out on, it's actually the last 10 years. And the point of the graph is to actually highlight particular things, which is make sure that you start as soon as possible. And if you can, delay your retirement for about 5 years, just because you can see the effect that compounding has in the latter years of your investment. So another point that I need to make is that if you have existing savings and you decide to move between jobs, you get an option to either take your savings and withdraw it, or you have an option to transfer your savings and keep on saving. It's important to note that if you decide to take your savings, this essentially starts all from over again. So effective compounding is really important when it comes to your retirement savings. And then principle number 3 is the importance of real returns and highlighting or knowing how important real returns are. So real returns are essentially the return that you earn above inflation. And the graph also highlights two particular investors. The first one is an investor who invests in the CPI plus 5 fund, or 5% above inflation. And the other one is essentially an investor who just takes their money, their monthly savings, and puts it under masses. And I know that it's more a thing of the past, and people generally start using investment vehicles nowadays. But it's actually just to highlight the effect that inflation has on your investment and your capital amount. So this investor reached about close to 500,000, but after a while, the effects of inflation start to occur, and it starts essentially eroding the value of this client's investment. Something that we also often hear in the market is, my retirement savings is really important to me, so I'm investing in a money market fund because it's really important and I don't want to lose out on anything. And we've actually highlighted that as well. So this is also the CPI plus 5 investor, and this is a money market investor. An investor that decides to put the retirement savings in a money market fund. And what it does is you earn slightly above inflation, maybe a half or 1% above inflation. But you can see that with the CPI plus 5 fund, there's two things that's occurring. The one is the client's earning a return above real, right? So 5% above inflation. And there's also the effect of compounding. And real return is extremely important, but it is also difficult to achieve real return. And because the reason that it's actually difficult is because performance doesn't generally come in a straight line. So if we look at a typical balance fund, you can see that in any 1 year, you could earn somewhere between 45% to minus 10%, right? And you might think that that's quite volatile, but if you look at it over a longer period of time, if you look at it over about 3 years to a 5-year period of time, you can see that return smooths out quite a bit, right? In order for you to actually make a real return, you have to have some volatility over the short term. And volatility can kind of be classified as investing in an uncertain outcome over a shorter period of time. So someone might look at this and say, okay, cool, over a 1 year period of time, I did minus 10%, so I'm going to take my money out, right? and that's risky. Remember, there's a difference between risk and volatility. Risk is essentially really dangerous because you can completely erode the capital that you have, whereas volatility is just purely the variation in returns over a shorter period of time. So someone might be in a typical balance fund and see their 1 year return and decide to disinvest in it because they want to reduce the risk in their portfolio. But that's actually the risky part. It's not necessarily the volatility in the returns. The main risk that comes with this is an investor's response to volatility and not necessarily volatility itself. And we can actually graphically depict what happens when investors incorrectly time the market or incorrectly switch out based on underperformance over a shorter period of time. So if we look at the first graph, we can see an investor. So the actual figure is 100,000 over investor that invested this, and they essentially end up with about 1.7 million, right? The second investor, they how we work this out is we took the 100,000 and we invested it into a balance fund, and we disinvested that at any point in time when the balance fund reached its peak in returns, just about before the time it's about to drop. We leave it in the money market fund for about a year, and then after that year we switch it back into the balance fund to try and essentially simulate timing of a market. The last investor, so this is the second graph, is the best time switches during that period, and then the last investor is the worst time switches during that period. So the one thing to consider or to note in this situation is that in order for you to achieve this only occurred 13% of the time throughout that investment period. This year happened 87% of the time. So the important question to ask yourself is whether you'd be willing to risk timing the market and knowing that the possibility of achieving that outcome is actually only 13%. In my mind, it's a lot safer. And it actually boils down to the question of, if you open up your online account or you check your investment balance and you see a return of maybe 40% in your fund, how many of you, of the normal investors, would actually panic during that time? Because that's essentially what needs to happen for you to be able to properly time the market. If you see your investment return on 40%, that's the time you should be thinking of essentially switching out. But the problem is that we can't always time that perfectly. The fund could go up to 70% and you miss out on the 30%, or the fund could drop and you could time it perfectly. But the odds are really, really low. We do know how much of a toll it actually takes on your emotions when you open up your fund statement and you see like a negative return. And we've actually graphically depicted that. We like to call it the emotional roller coaster of investing. Picture this line being the return of an investment, right? And this is essentially what runs through everyone's mind during this point. So you invested in this fund and it's doing really well. And what you tell yourself is, this is the best decision I've ever made. My fund manager is doing a great job. And naturally, that fund would after a while start declining, right? Until you reach this point where fear starts kicking in. And you think to yourself, the manager's not doing so well, I think I must move my money somewhere else. A lot of the times that isn't just a thought, it actually occurs. People at this point in time decide to switch out to kind of avoid any more further losses. The problem with that is that they only start looking at the fund again when it's doing really well. And then you're thinking to yourself, this fund manager looks like they know what they're doing. And we actually see that really often where clients look at the return, they see that they're underperforming, they then decide to switch out of the fund, which is completely the wrong thing, because they lose out on any potential growth that they would have, or recovery that they would have experienced during that period. And they decide to switch into the investment after this. So the line kind of goes up a little bit more, but it's most likely that after this point, the return would start declining again, and then the roller coaster would essentially continue. So this is how it looks theoretically, but we've actually really seen that. So this graph shows you, so the blue line shows you the previous year's return, but if you can pay attention to the black line, so the black line is the previous year's alpha. And what the alpha shows is essentially the return of a fund above its benchmark. And obviously there's a fund returns on the side, and these small gray bar graphs show the actual flows in and out of this particular fund. So you can see that when the return of this fund did -5%, there were massive flows out of this fund, right? And the same thing, you can see the same thing here. When the fund starts, has a positive return afterwards, you see massive inflows into the fund. And this is essentially, this whole graph depicts like poor investor behavior, where you see a bad return, you decide to switch out of the fund. When you start seeing good return, you start switching into the fund again. And this is essentially the riskiest part of saving for retirement. Being able to maintain and stick to your goals is the most important thing. And then the last investment principle is diversification. So diversification is one of the most widely used terms in the industry. Essentially, don't put all of your eggs in one basket. But when that's said, it's not invest in 10 different types of the same fund. For example, balance fund. Don't invest in 10 different types of balance fund. What diversification is actually referring to is making sure that your money is exposed to different types of asset classes in the industry. So, for example, it should be exposed to different types of shares. It should be exposed to property and to bonds. Diversification is essentially exposing your money to different economies, different currencies, and different types of asset classes. So if you look at a typical balance fund would have that diversification that you're looking at. So if you put it in one fund, it isn't considered putting all of your eggs in one basket. And yes, you can add multiple funds to that, but after a while, if it starts exceeding a certain amount of funds, that's essentially just going to smooth out the allocation that you have to each type of asset class, and you might even be earning market returns. So the important part of diversification is obviously to reduce the riskiness of your overall portfolio, which can be achieved with a typical balance fund. So just to sum it up again, make sure that you have a plan in place. Make sure that you start with a basic plan, that you set your goals up, your short-term, your medium-term, and your long-term goals. Start as soon as you can. We saw that during that period, the first 10 years were extremely important for the compounding that you get at the end of the period. So make sure that you start as soon as you can. Also, the importance of real returns. Make sure that you're earning a return at least above inflation, so to make sure that the value of your money doesn't erode over time. Switching and timing the market. Make sure that you try and stay away from it. It's that 13% chance that you're actually going to get it right, and 87% chance you're going to get it wrong. And then also diversification to make sure that you're reducing the overall risk of your portfolio. So what investment vehicles can we essentially use to end up with a capital at retirement? The products we have is, so there's a basic unit trust investment, and unit trusts can also be seen as the investments that you use for the emergency funds. For example, the car accident that you're in. The reason for it is because, like it says, it's flexible, and you can generally access your money really quickly within about a 5-day period. You also have endowments. So endowments are, there are a lot more rules when it comes to endowments, but it's essentially seen as a 5-year planning tool. And it's useful for estate planning because of the ability to nominate beneficiaries within the product. It also becomes really useful when you have, if you're a particular client that gets taxed at a higher rate, at a rate higher than 30%, because essentially all of your money that's in this endowment gets taxed at 30%. So if you earn, if you get taxed at 45%, there's obviously a tax savings that you can make use of. There's preservation funds. So preservation funds are essentially used if you move between jobs, and you get that option to either receive your money as a cash withdrawal, or you have the option to save your money. This preservation fund is essentially used for that, to make sure that you don't access your money before you need to. And then we have the typical retirement annuity and pension and provident fund. So these are the more commonly used products within the industry, but it's really useful because of the tax savings that you get when you're contributing towards the products. And then we have something called the tax-free savings. So if you know about the tax-free savings, it's really handy, but a lot of people misinterpret it as a short-term investment or a flexible investment or maybe an emergency fund. And it's actually a much longer-term investment, similar to a retirement annuity, because you're only able to invest, you're limited on the amount that you can actually invest in. So you have a lifetime limit of 500,000. But where people misunderstand the product is that if you have about 100,000 saved up and you decide to withdraw 30,000, that means that your lifetime limit obviously reduced from 500 to 400,000. But once you withdraw that 30,000 from it, it doesn't go up again. It only records the contributions that you put into the fund. And also it's much longer term because you can only invest about 36, there's an annual limit of 36,000 per year. So the point of it is to try and save up to that or contribute that 500,000 and let it grow and let the compounding take effect. And when you do need it at retirement, that's when you start accessing any of that, the capital within it that's completely tax-free. And then lastly, we have offshore investments. So offshore investments is obviously when you want to expose your money to foreign assets, and it's in a foreign currency. You would need to convert your money from that to US dollar or to pounds, and then invest it in foreign assets. So if you do need a little bit more information on how to go about accessing this, you can obviously speak to Marcelle about it for further information. And then lastly, one of the most important questions we get at retirement when clients start receiving income is, how much can I withdraw? How do I know that the amount that I'm withdrawing is going to sustain me for my entire retirement journey? And just to remind you about it, the final salary that you get essentially is, or the amount that the capital that you've saved up is going to be 75% of the last final salary that you're going to receive. Also, it's going to be for a period of about 20 to 30 years, right? And in order for it to be sustainable during that time, you shouldn't look at taking more than about 5% of your capital during that period of time. And obviously, you convert that to rands if you want to work out the rand figure, and that can annually increase by inflation just to keep up with, to make sure that the income that you're receiving isn't eroding. But the important thing is to make sure that you maintain about a 55% equity exposure. If you look at it, you're going to be invested for about a period of 20 to 30 years. And in our world, that's still considered a longer term investment. Not only will you be eroding that capital by withdrawing 5%, in order to keep up with that, you need to be able to earn a return that's above 5% to make sure that you're not further eating into your capital. And if we look further into this, ASISA actually released a guideline, which is a table to show you how much income should be withdrawn during your retirement years. So if we look at this table, you can see, for example, a client that's receiving 7.5% income during the year. If they earn this is return on top and the income on the side. So if they're withdrawing 7.5% per annum, and they're achieving a return of, let's say, 7.5% per year, this tells you how long your capital is going to be lasting. Your capital is going to last before you start eating into that capital. So, for example, a client that's receiving 7.5% and has a return of 7.5% per annum, their capital will last 10 years before they start eating into their capital. The same applies with a client of, let's say, 2.5%. If you decide that, and obviously this is all based on client's financial position, like if you're earning an additional income, you can afford to keep your final savings or your final capital at about 2.5%. So if you're a client that's receiving 2.5% and you have a return of 10% per year, essentially your investment or your capital is going to last 50 years before you start eating into your capital amount. So this table has been used for a while now, and I hope that it's still all there when you guys decide to retire, so that you have obviously something to work with. But yeah, that's essentially the basics of retirement. And that concludes the webinar. Marcelle?
Thank you very much, Shauib. That was very informative, and I hope everyone that joined found it interesting. I don't know if there's any questions, and if anyone would like to ask any questions now, or perhaps drop me an email or put it in the chat. I didn't see anything